Now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and thank you so much for taking the time to join us today for our annual Year-End Planning Opportunities webinar. My name is Nick Defenthaler. I am a lead financial planner at the center, and I'm also the director of our firm's financial planning department. And I'm also happy to have Melissa Joy presenting with me today. Melissa is the director of wealth management for the center, as well as a partner and lead financial planner with the firm. Today, we're not only going to cover some tax planning strategies to consider before year end, but we're also going to touch on some various financial planning topics, including possible tax reform that should certainly be on your radar as we enter 2018. Just one quick housekeeping item before we dive in. Because we want to be respectful of everyone's time today and stay true to our 45-minute time slot, we have disabled the chat function on the webinar and ask that if you do have questions, certainly reach out to Melissa or I after the webinar, and we'd be happy to answer any questions that you may have. So with that, I will hand it off to Melissa Joy to get us started.
Thanks, Nick. Well, I was thinking back as I prepared for our presentation, and we put this on the calendar about 6 months ago,
right,
not knowing that we would be embroiled in possible major changes to taxes as we know it. And really, even though we've had some cuts and adjustments to taxes along the way, particularly with stimulus, we haven't had tax reform. If we think back to the last time that this occurred, we'd be thinking back to 1986. Ronald Reagan was in office. Democrats were controlling the House of Representatives, and there was a long, arduous effort to really change tax code. I don't think that it would be unfair to say I was in elementary school at the time. Nick, you were in diapers. This is something that was a long time ago because we're not babies. So, you know, now there is tax reform looming, and in order to understand what's going on, I think the first place to start is to understand the loopholes that may be able to pay for the cuts. Because there are certain components of our taxes that incentivize us to behave certain ways. And this is a look at some of the costs of those incentives. So one of the biggest costs is just as an employer paying for health care for your employees. And then we go on down the line through certain things that are going to be impacted with the potential suggestions for tax reform. Those include deductions for state and local taxes, which is something that is more prevalent on either coast. So it heavily impacts states like New York and California, and is definitely a component of the recommendations for the tax proposal that's in the House, and is even more aggressive in the Senate. Mortgage interest deduction is something that's quite popular, and that's being limited in some of the proposals. Also, other things that you may be quite familiar with include your deductions for retirement plans. That was something that was on the table as a consideration, and at this point it seems like the reduction in taxes when you make a contribution to your retirement plan is safe. But every one of these issues has a certain interest group that will feel significantly impacted when those things are taken away. Nick, I don't know about you, but when I saw that a flexible spending account where you can put away money for daycare might be impacted and go away, I felt personally like something was being taken away from me. And when you think about that, that's really what happens when you roll up something that people have had and counted on. That's when things start to get sticky. So we're starting right now at a point where the legislation is rolling through the House and the Senate proposal is on the table, but there is a lot of back and forth that's going to be necessary before the ink is dry on a piece of legislation. Now, to tell you how kind of intractable these conversations are and universal they are since we've had taxes about 100 years ago, this is a political cartoon not from recently. It's from Dr. Seuss in the 1940s. So he also had some political cartoons. And he's talking about tax-exempt securities loopholes for the rich. We would know those as municipal interests today, and there was a question of the haves and the have-nots back then about whether those were appropriate. So this is an age-old, kind of turf fight, and municipal securities are not on the table today as being taken away for their tax-exempt interest for the most part. But it's certainly something that is what's old is new again in terms of the not my deduction.
I think it's fair to say no matter what time frame we're in, there's always going to be a debate around taxes and how those should be structured. And as Melissa, we just switched over to the next slide here, where we take a look at the different brackets that are being proposed. Now, keep in mind, the ones that we're looking at on the screen right now are for those who are married filing jointly. There hasn't been as much clarity on exactly how, if you're single, how those rates might shake out. But if we kind of compare it to how current tax law stands, in most cases, the income levels that you see on both sides are roughly half of what the limits would be for single filers, but we really don't have.
Yeah, in many ways it's simplified.
Exactly.
Except in those middle areas. So.
100%. So
right.
Sometimes, just depending on the thresholds, they're not quite the 50%, but just want to give everyone on the call some context. If you're not married, of course, this is going to look a little bit different if you're a single filer, but we don't have a ton of context quite yet because the proposed tax reform is still somewhat in the infancy stages.
And just to add another wrinkle to that, the Senate proposal has some extra brackets that are added back in. So, we're operating with the information we have today, but this is not a done deal.
Correct. A matter of 2 or 3 weeks ago, there was actually 3 brackets that were being proposed: the 12%, the 25%, and the 35% bracket. And then after some discussion in the House, the 39.6% bracket was brought back in. As you see at the very top, currently that is a rate that exists in our tax code, but as you can see between the two income levels, they look dramatically different. So the proposal currently is suggesting that we move from 7 tax brackets down to 4. And obviously when you do that, there's going to be some compression on income levels and things of that nature. So I think this particular graphic does a good job of explaining how those brackets and how the income levels could potentially shift around if tax reform does end up going through.
So I would mention that things look pretty good here for many of our clients. If you just look at the proposed brackets in terms of will you be paying more or less, it seems like for many you would start with an assumption that you may be paying less. It's not universal, but that's, when you just first look at those brackets, they're significantly higher to get to that top tax bracket. You need to make about $1 million as a couple versus about $500,000, right?
Correct.
So then let's look, there are some trade-offs. So in order to get those lower brackets or the tax rates that are lower for your income, we need to go back to that list of kind of the loopholes and say what will account for that. And so as we look at a summary of the proposed changes, there are some other very popular deductions that are being eliminated or significantly reduced that will help to kind of change outcomes family to family, person to person. One of the most hotly contested considerations is that state and local taxes may be eliminated or reduced depending on which plan in terms of reducing your overall federal tax obligation. And it depends on where you're sitting as to how that looks for you. It depends on how high your state and local taxes are. As I mentioned, the coasts are quite a bit higher, and we have quite a few clients that would be impacted by that. If you're sitting in Michigan, you say, don't people that live in California and New York have just as much of an obligation to kind of pay for things on the federal level? So it all depends on your perspective, but we do have some planning suggestions that go in line with that. Also, your mortgage deduction would be capped for future mortgages and even refinances where cash is taken out, or home equity loans could be impacted in terms of their deductibility of interest. That's something that we're all very familiar with and used to using. Also a cap on property taxes. fortunately not taken away, but for larger properties would likely be impacted. Nick, do you want to talk about the standard deduction?
Sure, absolutely. So the standard deduction as we currently sit right now is at $12,700 if you're married, $6,350 if you're single. So as we can see, the proposal that we're looking at right now is essentially doubling those, just shy of doubling. So what this is intended to do is really to simplify things in many cases, not have quite as many different types of deductions that one might take. In many cases, even itemized deductions that I see on client tax returns, in many cases, they don't even exceed that $24,000 or $12,000 if they're single. Some do, some don't. Obviously, every situation is a little bit different. But the thought is that if we simplify this a little bit more, in many cases, some folks will be better off. But every situation is slightly different. The elimination of personal exemptions as well is a hot topic. So for larger families, my wife and I just welcomed our second child about a month ago. So that's an exemption that we could potentially be losing, depending on your situation. The larger standard deduction could make up for that. But there is some talk as well about increasing things like child care tax credits as well to make up for that. As Melissa mentioned, no change to 401k deductibility. That was a biggie that was getting tossed around and has not been present in any of the recent proposals. Maybe you can speak to some AMT items, Melissa, because I know this is a hot topic for clients that you work with out of state, because oftentimes this comes up with states that have higher state taxes, essentially.
Right. So one of the proposed simplifications is that the AMT would be eliminated. Thus, there would be certain items that would increasingly be deductible. But again, this is something that is a case-by-case calculation in terms of how it would impact you personally. And furthermore, the estate tax, which is currently impacts individuals who are around $5.5 million in terms of their estate at the time of their death, and for families or couples, it is at $11 million, would go up significantly right off the bat in the House plan, and then be completely eliminated in the 2020s. So that makes a big difference for some of the planning that we do for families that are subject currently to the estate tax. Now, this may not go away forever, though, because this bill is being done through a reconciliation process. And the Byrd Rule, which was enacted in the 70s, says that anything that adds to the deficit over cannot do that over more than a 10-year period. So the estate tax may be eliminated, but the question would be, for how long?
So Melissa, would it be fair to say if you are in an estate tax situation currently and you've done a tremendous amount of planning to help navigate that potential tax, it might make sense still to hold tight, not undo any of that planning that you've done thus far in preparation for a potential estate tax situation?
Yeah, I haven't spoken with any estate planning experts, estate planning attorneys who say to unwind or undo any of your planned gifting if you're subject to estate taxes or planning to avoid estate taxes. And in fact, if we look at over time, if you see the chart on the left, estate taxes have been all over the place over the last 100 years. So in fact, as recently as 10 or 15 years ago, there was, for a very brief period of time, no estate tax. And then it was quite low at other periods of time. So, I should say not no estate tax, very, very low estate tax where many families would be impacted. So this is something that I think will continue to yo-yo. And the prudence of having in-depth, complex conversations about the impact of estate planning for you and your family is critical. And I think the role of a financial planner like us, as well as your estate planning attorney and CPA, when working together, and in some cases, insurance professionals as well, is always recommended and would still be the case after any proposal was passed.
Right.
And, again, this is estate tax is something that can also be known as a death tax. And it depends on, kind of the political winds in terms of where it goes. I think we have a really populist kind of feelings and leanings on each side of the aisle today politically. So expect the estate tax to potentially be a volleyball in that conversation. So as we think about all of that, what do you do sitting here with only about 6 weeks before the end of the year, and you're thinking, how do I plan for both changes? What are the opportunities today, or what could be the risks?
So as the slide, as we're looking at right now, delaying income and accelerating deductions. Now, we don't always have complete control over those items, but if you're a small business owner, or you have certain project work as a 1099 consultant, and you could potentially have some flexibility on shifting income, the timing of that, it could make some sense to explore that. As far as accelerating tax deductions, you could do things like prepaying your state or local taxes before the end of the year to ensure that you could still claim those on your 2017 return. That could be something, and I know, as I mentioned earlier, Melissa, you have a few clients in California and New York who pay substantial dollars in state and local taxes. I believe this is something we've talked about that you've recommended.
Absolutely. Yeah, so this is not new advice in terms of paying your taxes early if you have property tax bills. Thinking about if you live in a state where there's a high sales tax and you were able to deduct sales tax for example, a car purchase or something like that. If you're thinking about doing it in the first quarter next year, I might consider doing it in December. Also, we just kind of breezed over a small subset of deductions, but a very critical one for those impacted. Medical expense deductions would be significantly curtailed in some of the proposal language. So if you are at the threshold where it may be above 7.5% of your income, or you were planning on doing significant work next year. One example that I discussed with a client this week is some dental work they were planning to do, which would be a significant amount of money. Then it may make sense to try to see if that work could be done before the end of the year.
I think that's important. Just kind of circling in on the healthcare part of things as well, just for a minute. To add on to what Melissa just said, as far as a tax deduction for medical expenses, we're kind of obviously coming to the end of the year where many clients need to use up money in their flex saving or their flex spending accounts, or they may have already hit a deductible or an out-of-pocket maximum on their healthcare plan. So, we can't always plan for what our medical expenses look like, but the example that Melissa just provided, where we do kind of have an idea and have some level of control over certain procedures from a tax standpoint, and the way that your insurance is structured, and things like a health savings account or a flex spending account that we'll talk about a little bit more in a few minutes. Keep those on the radar as well, because they could have a big impact on your situation as well.
We're going to be talking about charitable strategies to reduce your taxes through itemizing for charitable deductions. Those were not impacted in the proposed legislation, even though that has been a conversation over the years to eliminate some charitable deductions. But in essence, because there is such a high increase to the standard deduction, for many families, you will not be able to itemize your charitable deductions. That may still be good for you in terms of your overall tax picture, but there are some strategies that we'll discuss that could increase your opportunity to use a charitable deduction this year and then give the benefits to the organizations that matter to you in the future. So we'll mention that under our donor advised fund section of this presentation. When I think about what you should be doing, though, and anticipating these changes, I'm going to recommend that you should know your financial picture well. Have a proactive conversation with the consultants, financial planners, the people that help you to make decisions, so that you are able to make efficient decisions when there is clarity in what is going on. It is not out of the question that the proposals that we know now could be significantly changed with very little time to make an adjustment. So know your picture and be cognizant that there may be opportunities, and be ready to act over the next couple months.
So 2018 updates. We're going to take a look here for a few minutes at some tweaks to Social Security, Medicare, gifting, retirement accounts, etc. So each year, in many cases, there are updates to certain income limitations, contribution levels, things of that nature. So about a couple weeks ago, the IRS released some figures of where company retirement plans will look like. And for the first time in, I believe it's been 3 years, you can now contribute a little bit more to your 401k, 403b, or potentially your 457 plan. And that's gone up by $500. So instead of it being $18,000 if you're under the age of 50 in 2017, you can now contribute $18,500 in 2018. We are still looking at the $6,000 catch-up if you're over the age of 50. So that total amount that you can put into the plan potentially if you're over the age of 50 would be $24,500. In regards to Social Security, there has been a 2% cost of living adjustment. It doesn't sound like much, but if we compare it to the 0.3% adjustment that we saw in 2017, it actually sounds a little bit more favorable. Now, in many cases, the cost of living adjustment that you see in your Social Security benefit is pretty much going to be erased by a slight increase in Medicare premiums. There's this interesting rule called the hold harmless provision that relates to Medicare premiums and Social Security, and it essentially says that your Part B premiums cannot go up any more than the cost of living adjustment with Social Security if your income falls at a certain level. For new folks going on Medicare, there's going to be another slight increase to Part B premiums. And there's also been some adjustments to income thresholds for Part B premiums, depending on the surcharges and where your income might lie for the year. So those who are at certain income limitation, or I believe it's under 170,000, if you're married filing jointly, you're going to pay one premium, and then the more money you make, or the more your adjusted gross income is, similar to our tax code, the more money you're going to pay for your Part B premiums. In regards to IRAs and Roth IRAs, the deductibility income limits for IRAs have gone up by about $1,000 or so, and then Roth IRAs, the ability to actually contribute to a Roth IRA, is now right around $200,000 for those who are married. The annual gift exclusion, that has not gone up for the last couple of years. It is going into 2018. So now instead of it being $14,000, it's now $15,000 going into the new year.
That's a lot to keep track of. And I would recommend we have a summary of this on our website under our blogs. And you're also going to be sending our clients the updated year-end tax planning guide in the next couple weeks, Nick, right?
Correct. Yes, absolutely. So keep your eyes open for that. And as Melissa mentioned, we've written many blogs on the different updates. And so go to www.centerfinplan.com, check out our website, check out our blogs. And I know I just threw a lot of information at everyone on the call today, but if you go to our website, there's definitely a dedicated blog to each one of these items. So that way you can take a look in greater detail to see how these changes might impact your overall financial plan.
I think the great news is that you are able to save more if you are accumulating wealth in retirement plans. So those caps do make a big difference for many of our clients.
Absolutely.
So also I find year end is a time where you gather with family, hopefully a couple times around the holidays between Thanksgiving and year end. And many times you're thinking about giving, you're thinking about your legacy. And so these are great opportunities to be thinking about how you can help the next generation in your family. Nick, one of the things that I know you like to recommend, and I was just discussing it with a client who has a grandson in college, is encouraging them to start saving for their own retirement through Roth IRA contributions. So this is a great way to, if they have earned income, give them a sense of what it's like to hopefully put some of their money with some skin in the game, as well as it could be great potential gift where they start to have some accountability and responsibility with money and investments.
I know we've had some clients had some great conversations with getting in that habit of saving for retirement. So as Melissa mentioned, with grandparents, it's a great tool or great idea to say, to their grandchild, if you put in $2,000 into your Roth IRA, I'll match that figure up to the limit. Whatever the dynamic might look like. But as Melissa mentioned, having the grandchild or child or whatever the situation may be, having them have a little bit of skin in the game and some accountability really can help mold and shape those quality savings habits as they enter in to the workforce and are accumulating throughout their career.
I agree. Many people also are thinking about how do they pay for college for kids or grandkids, and how can they do that in an efficient manner. And in many cases, we recommend considering 529 plans. You do get a small state tax deduction, and they offer a lot of flexibility. So people like to ask, do I have to go to school in Michigan if I use a Michigan 529? No, you've got a lot of flexibility. In fact, in the new tax proposals, there's even some consideration for using 529 money for private high school or elementary school as well. And you maintain control of those accounts. You do not pay taxes on the growth of the accounts as you prepare and raise your kids. And then there's a lot of flexibility in terms of what you can use for education expenses when you need to do them. I find people find it, if they don't have professional advice, it's challenging to know when to start, how to start, and how to balance the need to save for their kids for a very expensive tuition bill down the road with how they save for themselves. So one of the great bridges that we provide is an organized understanding of how they can make it work so that they're both able to save for their kids as well as able to pay for themselves, because their kids are not going to want to pay for their own retirement. And unfortunately, you can't take out a loan to pay for your retirement. Another thing we're thinking about more is just different ways to make an impact for next generation. Maybe it's adult children who have mortgages and interest rates are going higher, so interfamily loans are sometimes discussions. We think that it's great to start to do charitable giving if you're charitably inclined along with your kids and grandkids, because that's one great way to teach about legacy, see how they think about money in a safe way where you're not showing your overall balance sheet. And then we always think it's ideal to talk frankly with your family at the level or at the place where they're ready for it about family governance, family meetings, what money means to you as a family. So use those times together to fit in some meaningful conversation that may not feel like a money talk, but really is as you help to explore how the next generation thinks about wealth. So we've also, Nick, I know you really spend a lot of time counseling pre-retirees and early retirees on healthcare, and this is something, the costs of medical expenses are always top of mind. It blows people away how much they have to spend. What do you advise this tax year and always in terms of healthcare?
No, you're spot on, Melissa. I mean, typically healthcare is the one of the, if not the highest levels of expenses that you'll have in retirement. And oftentimes when we do analysis for clients when they come in, we'll even break out healthcare expenses, how those can impact the long-term effect of your overall financial well-being and your financial independence. So we really want to dial in on this early on and kind of have a game plan. And one of the ways that we can help clients be proactive would be contributing to a health savings account. Now, not everyone has the ability to contribute to an HSA. You do have to be covered under a high deductible healthcare plan to be eligible to put money into an HSA. But in many cases, it's an additional way to save money on a tax deferred basis. You are getting the funds are going in pre-tax, just like a normal 401k. And in most cases, what we'll recommend that clients do is they accumulate the dollars and they begin investing those over time. And then you actually pay the medical expenses outside of the HSA. Now, I know that sounds a little counterintuitive because in many cases, you're told by your employer, you can put money into this plan and ultimately take the money right back out, and you got a tax deduction on the medical expenses that you know you're inevitably going to use. But one of the planning tools that we've seen work really well for clients is actually paying those expenses outside of the HSA and using it as another tool to use throughout retirement to cover healthcare expenses.
That makes a lot of sense. How about for those that are subject to Medicare? Not subject to, are using Medicare. What am I saying?
Absolutely. So as I mentioned a few minutes ago, Part B premiums are going to change. Those adjust each and every year. One thing that we always recommend to clients, and it's great now that we have a few phenomenal resources at our disposal to help guide clients on their supplemental policies. So, and that's just not limited to people who are going on Medicare when they turn 65. Reviewing your supplemental policy each and every year is something that we would advise. The landscape is always changing with Medicare, whether it's your income levels or different changes to what the insurance company is going to cover, etc. And so depending on the way or how many different retirement accounts that you own, or the type of income that we're drawing off of your portfolio to get you that retirement paycheck, we want to be cognizant of where we're pulling those dollars from, because we have seen situations in the past where clients take too much out of one particular account and it ends up increasing their Medicare Part B premium. So many of these financial planning topics that we're discussing today are separate, but they intertwine. And so that's why we want to meet with clients at least once a year and review those items to make sure everyone's on the same page.
I know I was glad for early retirees to hear that as of now there still is Affordable Care Act. And that's because while it wasn't a hotly discussed topic, that is something that early retirees depend on in many cases, as there are less and less offers of health care with your retirement package. How have you advised people on that, and how may that be changing?
That's a huge advantage, that people actually have access to some sort of healthcare plan, even if they're retiring before 65. Just like pensions, offering healthcare to retirees for a company to do that over the course of a 20 or 30-year retirement is becoming more and more rare. If you do have healthcare expenses paid for, you're in a great position, but many folks who are retiring now or in the next couple of years simply don't have that benefit. So one thing that we help clients do is navigate the individual healthcare plans that could potentially make some sense for them, and ultimately taking a look on how to structure their income, because if we can recreate your retirement paycheck in a certain way, it could potentially lower the amount that you pay each month for your premium. So there's a lot of nuances that go into healthcare, especially when you retire before 65, that we'll want to evaluate.
And when I think about early retirees, I go right back to that health savings account conversation. So if you have been able to save over time, then there's a source potentially for your premiums.
Correct. Now, Melissa, I know one area that you spend a lot of time on is helping clients draft almost a charitable giving or philanthropic policy statement, so to speak. And you can probably word it a heck of a lot better than I just did.
No, you did great.
But I know this is an area of focus for you, and you're very familiar with the donor advised fund. So maybe you can give us some clarity on how this could make sense for clients.
Well, it only applies if you're charitably inclined first. So I hate to say, hey, here's a way to save taxes, because you are giving away money. So that's an important first step. But many people still aren't familiar that there is an opportunity with a straightforward account called a donor advised fund, where you can bundle charitable gifts, perhaps for many years down the line, in times where perhaps there would be a bigger tax advantage from taking things all at once. And I'm thinking about this a lot more, frankly, because of the new tax proposals, because frankly, many people will not be itemizing, and thus their smaller charitable gifts will still be very meaningful for the organizations they give to, but it won't matter as much for their tax bills. So what happens with a donor advised fund is you can gift cash, or ideally appreciated stocks, to a fund that you would still be able to manage in terms of its investments, but you have made a commitment that those funds will eventually go to a 501c3 organization, just like your charitable gifts do today, you get to control when and how those gifts will be made. So you can do them down the road. And this is a discussion, if you do have that charitable inclination, it is one of the first things that attorneys and CPAs and people like us think about as a possibility between now and the end of the year if you are going to fall kind of off of the typical itemizing.
Gotcha.
But then also, I'm thinking forward, and we have talked to a lot of clients that have liked to use the qualified charitable distribution when they're in a required minimum distribution period over ages 70 and a half. And I think this will become a more critical tool if the tax proposals are passed. Can you explain how that works?
Sure.
Nick?
So the funds that you're gifting to charity under the QCD is a very important, logistical or administrative component. The funds have to go directly from your IRA to the charity. It's something we help many clients with each and every year. And really what this does is it takes that income off of the front of the 1040, or the first page of that tax form. So we would call that a above the line deduction. Okay, so it's a little bit different than taking a normal charitable deduction that you might see with the donor advised fund. So by not having that income flow through to your tax return, you can kind of sidestep the fact that you might not be eligible to take charitable deductions the same way that you were in years past, because standard deduction has gone up so much. A great way to help mitigate Medicare premiums potentially if your income is a little bit higher, because Medicare premiums predicate off of your adjusted gross income. And if income isn't flowing through to your tax return because you gave it directly away to a charity through the QCD option, then that could potentially lower your Part B premiums. We've had that situation come up with certain clients as well. But as Melissa mentioned, very important component, this really applies to folks who are 70 and a half or older, and you're in that required minimum distribution, or that RMD phase. So you're moving money out of the IRA to a charity to help mitigate that RMD that you would normally face each and every year that you would have to pay tax on.
That's great advice, and I do think that it will become more commonly used. So as I think we would be remiss if we didn't cover some of the topics that are top of mind all of the time as a financial planner, but I think the turn of the calendar really makes people take stock of both how they did in the previous year. They set their resolutions. So I think it's a really natural time for us to be reminding some just good behavior. First, have you been reviewing your mix of stocks and bonds? And I say that this year when stocks have gone up significantly for quite a while and bonds have really treaded water. And so you may be going into a new, more aggressive risk area if you're not paying attention to your mix of stocks and bonds. I'd also mention that people, when they make selections within their retirement plans, sometimes they just look at recent performance, and recent performance may understate the risk associated with certain investments. So it's always good at all times, but particularly right now, to review your mix of stocks and bonds. And if you need some advice, talk to your financial planner or give us a call. Also, do you have funds sitting around that need to be invested? And there could be several reasons for this. Maybe you just have a to-do list that's a little too long and you don't know where to get started. Perhaps you have big year-end bonuses and you're thinking, how do I get things done? Perhaps you have a significant amount of your wealth accumulating in concentrated stock positions with your employer. Nick and I advise quite a few people who have stock options that they receive, and over time something needs to be done with that so that you aren't overexposed to one particular company that also happens to provide your income to your paycheck to you as well.
Kind of double dipping on the risk from a risk standpoint, correct?
Exactly. A lot of people get their raises at this time of year too. So what is your savings rate? And if it's not ideal, it's not where you want it to be, how can you make some adjustments at the same time that your pay changes so it doesn't feel as harmful to your pocketbook, and also you are able to, bump things up and pay not only yourself today, but think about your future self and take care of them too.
one thing that I do personally is I increase my 401k and Roth IRA contribution level by about 1% each and every year. Now, that might not make a huge, at least 1 to 2% each year. So
I think it does make a huge difference. So don't minimize it. I think that's a great thing to do.
It might not make a big difference for that one particular year, but especially for those who are within the first decade and a half of their career of working full time, if you can continue to increase that savings level, in no time you'll be maxing out that 401k. And I think more than anything, it's just a creation of good habits of being consistent and steadily increasing your savings rate over time.
I agree 100%. Also, you should be thinking, if you are saving in taxable investment accounts, brokerage accounts, then are the investment choices that you have in those portfolios as tax efficient as they can be? Certainly, as you make money with investments, you should expect to pay some taxes over time, but there are strategies that can be utilized in order to control those tax costs. And I think it's important to remember that you and your advisors have some control over that. So you can't just put that on autopilot. More than anything, though, stick with the strategy that you do in good years and bad. Keep calm, keep investing, and we would certainly suggest that you have a thoughtful investment plan in conjunction with a financial planner in order to get things done. How about, as you think about, one of the things that we have a lot of control over too is how you pay taxes when you are in and preparing for retirement. What would you suggest, Nick?
Right. There? So this is a really hot topic for clients who are within a couple years of retirement or have recently retired. It's really a question of, how do I get paid? How do I get my retirement paycheck? I'm so used to working and putting money into my 401k or my IRA and getting a paycheck from my company. Now it's this paradigm shift of taking money out, and it can feel quite uncomfortable, and rightfully so for those first couple of years. So we really spend a lot of time with clients to make them feel comfortable, develop an intentional plan for your distribution strategy. In many cases, the accumulation side of financial planning is kind of simple. You're just saving while it's simple, but it's not easy. You have to save, you have to be consistent, select the right investment portfolio. But, when you come to this decumulation mode for retirees, which, represent a great majority of our clients, there's a lot to that as well. So we want to take a look to see what tax bracket are you in right now, especially if you're still working, compared to where you're going to be in the future, because that could impact. Does it make more sense to have money in a traditional IRA, or should we be converting money to a Roth IRA? In many situations, I see this, 3 to 4 year period of time where there might be a gap before Social Security begins or a pension begins, where income could be potentially quite low. So we might do some things like Roth IRA conversions to take advantage of you being in that lower bracket and shift money to an account that's going to grow tax-free for many years to come.
Nick, I would also mention that because of the new tax proposals, the ability to deduct the state and local income taxes that you have due to a Roth conversion may be going away.
Correct.
So this is a particularly critical year for conversion conversations, and also the ability to recharacterize, which provided a do-over in essence for conversions, may be going away as well. So so there's both a wrinkle which might make you think more about this year. There's also a wrinkle that limits your flexibility there, so you need to be very careful as you plan.
It's an excellent point, Melissa. You want to make sure that you take advantage of these opportunities when they do arise, and make sure that you're coordinating with all the appropriate advisors to make the best plan.
So I also think that one of the things that is evergreen is thinking about the taxes on your taxable investment accounts. And we recommend not only perhaps accelerating some gains if you're in a very low tax year, especially when the 0% bracket still exists, but also selling positions that may have lost value if you're in a very high tax year. Now, many people think about this only at year end, and certainly we do a sweep over accounts and review circumstances right now, but this is something that you can do throughout the year that can really make a difference in the taxes that you owe and the taxes that you pay. So you're able to often keep similar positions but move in and out of a certain investment that may have lost value, even though you do think that long term you want to own it, and there are opportunities to take advantage of a realized loss.
Can't control what the market does in many cases, but the way that we actually manage some of those losses when they inevitably do occur is something that we can control.
So we've spoken very generally as we prepared this presentation, but as I think through just so many different people where everyone really is coming with their own story and their own personal circumstances, I want to emphasize that there are planning opportunities for each of these descriptions, and there are certainly planning opportunities for you. The first thing on our list was a business owner, and as I think about the changing complexity of corporate taxes and the potential for potentially lower corporate rates for some places and not for others, then I'm thinking, it's a good time for a conversation. It's always a good time for a conversation. Nick, you think about a lot about people who are retired and about to retire, working with younger people who are just coming into their peak accumulating phase, like my peers who are Gen Xers and yours who are millennials. Divorce planning is something. We have someone on staff now who spends all of her time advising people during divorce, and that's certainly a very sensitive tax and financial time in general. When you've just had a kid too, there are certain planning opportunities, and that's why we run financial plans every year for each of these groups. As your life changes, so does our financial plan. So make sure that you're talking with someone about your personal circumstances, because a generic conversation that is meant for a broad audience may not touch on the best advice that's right just for you.
So this is just a really quick snapshot. We're not going to spend much time here because I know we're kind of pushing up against our time limit. But some key dates to plug into your calendar from a tax standpoint that you certainly want to keep on your radar as the year winds down and as we enter into the new year. We've captured some items on when you can contribute to a Roth IRA or traditional IRA, tax filing deadlines, those sorts of things. One important item, it's at the very end, or at the very bottom, I should say, but it's a little bit light in the color there, so I certainly want to make sure I pointed out that the fact that December 31st falls on a Sunday this year, so if there are any last minute planning items or planning tools that we want to take advantage of before year end, we want to evaluate that ideally a week or so before the end of the year, but to avoid any last minute scrambling, especially because we do lose a couple days with it falling on a Sunday.
Yeah, and I'd say, last minute planning should start this week.
Right.
The sooner
We're all
the better.
guilty of
Even
it.
with last minute, you can kind of have an initial conversation, and then we can schedule a time that gives us enough time, because not every action can be done in the 11th hour. So when you're anticipating that you may have some last minute adjustments, give us a heads up, and we'll be happy to help. So, talking about taxes is just the same as approaching all of the areas of financial planning. We think that when you have financial planning as a process within your life, that we can help make your life better and transform the opportunities that are there for you. And the beauty of this is not in any one, kind of engineered process. The beauty of this is in conversations where we can help show you how to retire early in a cost-effective way, where we can show you that you would be able to take care of a family member that is in need. It's all of those things that you may or may not anticipate that mean a lot to you, and we are so appreciative of the opportunity to work together with you for your needs. So I think there's a certain component of gratitude that comes with year-end reflections, and we wanted to make sure to extend our gratitude toward you for the opportunity and ability to work with you to live the life that you want to lead. Now, as we look forward, a couple housekeeping items. Thanks for your time. I know we're a few minutes over our 45-minute deadline, but if you have questions, please reach out to Nick, myself, anyone here on the team. We don't have the phone number up there, but call us at 948-7900. Nick, I know you're going to be adding some year-end planning resources as we get everything kind of tidied up. What's coming?
Absolutely. So Melissa and I, over the last, I believe it's now our third year where we've done this webinar together. And we do webinars all throughout the year, and this is usually one of my favorites. So I'm glad to do it once again. And we always typically pair the webinar that we put on for clients with the year-end planning opportunities guide. So it's really that white paper. It's about a 12 to 15 page white paper. It's very organized, easy to read, great guide to use. That's going to really compress a lot of the topics that we talked about today into that one-page or I shouldn't say one-page document, but in that document that
Summarize.
Exactly, a nice little summary that you can use as a resource going into the new year. That's going to be on our website very soon under the resources section. And it's a great tool to use for clients, for tax professionals, for other strategic partners that we work with.
I've written up a comprehensive summary of the House GOP proposal on the tax proposal, and I am watching intently as we know more about the Senate proposal, and then ultimately whether there's passage on both sides so that there is a consolidation of the two bills, because I think if they are passed, they will come through in different formats and versions. I had to chuckle at a quote that I saw from a GOP senator, Senator John Kennedy of Louisiana. Today, he said, "I would rather drink weed killer than not pass this bill." So there is a lot of determination, and I anticipate that I will be updating information on our website, on our blog page, moneycenter.com, shortly. Furthermore, we do have monthly webinars, so our next webinar will be on December 12th. You can find information on the webinar page of our website, and that is an important webinar on grief and healing from Peter Lichtenberg, who has twice been widowed and wrote a book about his experiences that may be beneficial to people in your life who have suffered from loss. And then we planned our webinars for next year. A sneak peek, we'll have a very, I'm sure, popular topic on cybersecurity with Raymond James, cybersecurity expert, on January 24th. So be looking for notifications on that. And in the meantime, just stay tuned and posted with our monthly newsletters about our blogs, webinars. This webinar will be recorded, so you'll be able to see that too.
Great. Well, thank you so much for everyone once again on attending, and we wish you nothing but the best as we close out 2017. Have a great day.
Thanks.
And I think we did go a couple